Understanding the DuPont ROE decomposition. We've been introduced to a number of different types of ratios. We've been introduced to asset turnover ratios, which effectively measure the efficiency of our firm generating sales with our assets. We've been introduced to profitability ratios, such as our profit margin or return on sales. That's net income divided by sales. And it measures our efficiency or the amount of income that we generate on every dollar of sales that we make. And we've been introduced to a broad category of debt or leverage ratios, our debt to asset ratio, or the equity multiplier, which is total assets divided by total equity. Both of these measure the firm's relative use of debt and equity in its capital structure. In other words, how does it choose to finance its assets? Let's go ahead now and take a look at the basic DuPont equations. The DuPont equations examine the relationship between various ratios. Consider return on assets. Return on assets has two drivers, the profit margin and the asset turnover. Again, our profit margin simply our net income divided by sales, and our asset turnover was how efficient we were at using our assets to generate sales, and that was sales divided by assets. Our sales cancel out, leaving us with our net income over assets, which is our return on assets, which is a measure of how effectively we are at using our assets to generate income. Our return on assets, again, can be broken down into two parts, our profit margin and our asset turnover. Again, two drivers. And anything we do to increase either one of these drivers, in other words, improve turnover or improve our profitability, will boost our return on assets, which would signify an improvement in our operating performance. So the question becomes, one, how can we boost our profit margin? We could boost our profit margin by raising our prices. We could also consider cutting our cost. For instance, we could spend less money on advertising, reduce our workforce, use lower quality raw materials or components in our product, or perhaps spend less money on research and development. The problem with all these choices is they're likely to reduce our sales in the short term, or certainly at least in the long term. Thus, they will reduce our asset turnover. So the impact on our return on assets is uncertain. Alternatively, we could try to boost our asset turnover. We could do this by having a sale. In other words, try to generate more sales with our existing assets by marking down our merchandise. We could keep our store or plant open longer hours. The problem with both of these choices is that it's likely to decrease our profit margin. Marking things down means lowering our sales price and dropping our net income. Keeping our store or plant open longer hours will typically increase our cost, which is also likely to reduce our profit margin. So once again, we find the impact on our return on assets would be uncertain. Ideally, we want to find things that will both boost our profit margin as well as our asset turnover, because this would guarantee an increase in our return on assets, and this would signify an improvement in our operating performance. Let's dig a little bit deeper into our return on assets and try to understand how these two drivers function or work together and what the trade-offs are. Let's consider a company such as Walmart. Walmart has a low profit margin and high asset turnover. Remember its tagline, low prices always, but it sells a lot of merchandise. In the most recent year, over $450 billion worth of merchandise. Anytime you go to a Walmart, day or night, there's typically cars in the parking lot and long lines in the stores. So while they make very little on every dollar in sales, typically 3 cents for every dollar in sales, they have a very high turnover, and thus a decent return on assets. A jewelry store, on the other hand, is signified typically by having high profit margins but lower asset turnovers. They have a great deal of markup, but customers don't return every week or every month. In fact, I'm playing it right with my current wife, and we're on year 23, so I haven't been back to the jewelry store recently at all. Stores or businesses with high margins and low turnover are typically signified, or we can identify them because they have high barriers to entry. Consider utilities. High barriers to entry involve regulatory burdens, high number or level of investment in assets to open a power plant. And because we have high barriers to entry, there's typically low competition, which means we have higher profit margins on our products. Thinking back to our jewelry store, high barriers to entry in terms of the initial investment in inventory, and also there's barriers to entry into the jewelry market because you need some specialized knowledge. You need to know how to price diamonds and other gemstones. Let's go ahead now and take it one step further. While investors care about return on assets, they typically care more about the return on equity. So it's not just how much income does the firm generate given their assets, but how much income will the firm generate for me given my equity investment. And return on equity measures the amount of income the firm is generating given its equity investment. Keep in mind, typically investors will be concerned about the market value of equity, while most of our ratios are looking at book values of equity, but we could adjust them to take into account market values. Here's our extended DuPont equation. Our return on equity equals our net income divided by sales, which was our profit margin, our sales divided by assets, which was our asset turnover, and our assets divided by equity, which is our equity multiplier. Our sales will cancel out, as well as our assets, leaving us with net income divided by equity, which is our return on equity. Let's go ahead now and take a look at how we could use our extended DuPont equation to evaluate the returns that a business earns. Let's assume that we want to go ahead and start a business, and we have $1,000 to invest, and we don't want to go into debt. With $1,000 to invest, that means we can acquire $1,000 worth of assets, and we would say we have an equity multiplier of 1. We haven't used any financial leverage. With an equity multiplier of 1, the next question we're going to ask is, what do we have in the way of an asset turnover? Now assume we have an asset turnover of 2, and recall our asset turnover measures how efficiently or effectively we are at using our assets to generate sales. We had $1,000 in assets. If we have an asset turnover of 2, that means that each year we'll be able to generate $2,000 in sales. Now for an investor, sales are nice, but what's really important are what are our profits. This, of course, will depend upon our profitability. If our profit margin is 5%, we will generate $100 in profits on our $2,000 in sales. That's 5% times 2,000 gives us our $100, which gives us a return on equity of 10%. That's the $100 in net income divided by our $1,000 equity investment. We can calculate the same thing using our extended DuPont equation. Our 5% profit margin multiplied by our 2 for our asset turnover and our 1.0 equity multiplier gives us that same 10% return on equity. To better understand how these three drivers influence or impact our return on equity, let's consider another example. In the second example, let's consider using some financial leverage. We're going to assume that on top of our $1,000 investment, we're going to borrow $1,500. This means that we will be able to acquire $2,500 worth of assets instead of the $1,000 assets we had when we weren't willing to use financial leverage. We would have an equity multiplier now of 2.5. We have $2.5 in assets for every $1 we have invested in equity. Recall, our asset turnover was 2, so our $2,500 in assets will generate $5,000 in sales. With a 5% profit margin, we will generate $250 in net income, which means our return on equity will be 25%. That's the $250 in net income divided by our $1,000 equity investment. And we can get the same amount by taking our 5% profit margin, multiplying it by our asset turnover of 2, and finally by our equity multiplier of 2.5. So again, we can see there are 3 drivers that influence our return on equity. That's our profit margin. Anything we do to improve our profit margin will improve our return on equity. There's our asset turnover, as well as our equity multiplier, the amount of financial leverage we're willing to take on in financing our business. Anything that we can do to increase either one of these 3 drivers will improve our return on equity. To the extent that we improve our profit margin or asset turnover, to drive an increase in our return on equity. We are actually improving our operating performance. And I think all shareholders would agree that that's a good thing. However, to the extent that we increase our financial leverage, we'll boost our return on equity, but it comes at the expense of taking on additional financial risk. And whether this risk is good or bad largely depends upon individual investor preferences. Let's consider two companies, Company A and Company B. Notice our graph. We've got risk on the horizontal axis and return on the vertical axis. Company A is a low risk, low return company, and Company B is a high risk, high return company. Which company is better? Well, it all depends upon your risk preference. Are you willing to take on the additional risks to earn higher returns, or would you prefer lower levels of risk and be willing to settle for a lower level of return? So again, anything we do to improve our profit margin or turnover will increase our return on equity, and that's an improvement of our operating performance. But improving or increasing our return on equity simply by taking on more financial leverage, whether or not that's a good thing or bad thing will depend upon the investor. It's a trade-off between higher returns, but with higher financial risk.